Hey y'all, I'm Erica Parker, your queen of real estate with eXp Realty. Today, we're talking about wraps, and I'm not talking about the wrap that you have really fast talking, and I'm not talking about the wrap you can eat. I'm talking about a wrap mortgage, which is going to be something that we see a lot more of in the coming days. Now, if you're an investor that's tired of, doing the tenants and toilets or having all these insane maintenance costs, then you need to stay tuned. And if you're a seller or realtor that is thinking about selling or may have that rising interest rate and that rising inventory to compete with, really stay tuned to this, because this exit strategy is something that is just a mind blower, and also something that could be awesome for you, either as in the ability to sell or using it as an investment later on, and a more solid investment than maybe say the market, right, the stock market right now. So definitely stay tuned. I want to welcome everyone today. Give me a big thumbs up if you're excited about learning about this particular exit strategy, because I am pumped. I think y'all are going to love it. And so what we're going to do is first go over what a wrap mortgage is and kind of talk about the numbers in a very high level. It's definitely, it may be something that you're going to have to write down so that you can understand it later, but we'll just kind of talk through that a little bit. And then we're going to move into why an investor or a seller and realtor might look at this and why it's a good thing. We're going to also address the risks. And finally, we're going to wrap up by how to mitigate those risks and the appropriate way to address doing a wrap mortgage. So starting off, a wrap mortgage is basically you sell a property that already has a mortgage on it, and you wrap around that mortgage. So what happens? So here are the numbers. Here come the numbers so that you can kind of get an understanding of what I'm talking about. You bought a house. You put 20% down. It's a $500,000 house. You put 20% down, and you got it at a great rate. You got it at 3%. So you financed $400,000 at 3%. That means that your principal and interest payment is around $1,686. Now, say you get to the point that you want to sell it, it's now worth $650,000. And the person that wants to buy it doesn't want, say interest rates are 6 or 7%, you're competing with all this other inventory out there. So not as many people can afford the 6-7%, but they have the down payment to put down for a $650,000 house. So say they put the 20% down at $120,000. You get to take that equity with you. Now, the other portion, that's $130,000 is 20% of $650,000. So the other $520,000, you actually wrap around the original mortgage. So you give it to them, say, at 5%. So it's less than the interest rates of the bank, but you become the bank. So they're paying their principal and interest payment would be around $2,000. If say you did it 5% at $520,000, their principal and interest payment would be around $2,791. That is a difference between the underlying payment that you're making at $400,000 at 3% of a principal and interest payment of $1,686, and them paying the $2,791. The difference is $1,105. So yes, I know this is a lot of numbers thrown at you, but that's $1,100 that you're putting in your pocket each month. That is not anything else but cash flow. You don't have to do maintenance anymore. You don't have to do any of those things. But let's look at that return. So you have $100,000 still of equity, probably a little bit more, $120,000, because that's what they ended up wrapping the mortgage at. But you have $120,000 of equity in that property. If you're looking at this at $1,100 a month, that's around $13,000 a year. So you're making a 13% return on your money in that time. So as long you have a 30-year loan, you're making $1,100 a month at 13% return. So that is way better than what we're seeing in the market, the stock market right now. So these numbers can blow your mind. So just stay tuned with that. Maybe write them down, take a look at it to see if you can understand it. But here's moving into why an investor and a seller might look at this. So first, an investor. You have a lot of investors out there that are tenants and toilets that are tired of most of their spread on their investment is going towards maintenance, and possibly they just want to get out of the game. They don't want to pay the capital gains cost and everything along those lines. This is a great strategy for you guys. You make that money, like I said, that $1,100 a month is not going to be, you're not going to have to deduct maintenance costs because the person that bought it owns the property. They're the ones that have to maintain it. They are the ones that pay the taxes and the property taxes and they pay the property taxes and the insurance. And so they're the ones that are making those payments. So you don't have to look at that. You don't get the midnight calls saying, hey, come fix my plumbing. Hey, like I can't make my rent this week. So you're getting out of the overall game of being a landlord. And in addition, you're not having to pay an insane capital gains tax of selling off all your properties and not knowing what you should do with that money. Because this way, the money stays in there, but you're getting a 13% return on your investment. Now, there could be a difference in what numbers you end up working with, but this was the example I wanted to give. As a seller and a realtor, the reason why this is so awesome is that, the interest rates and inventory are starting to expand. And they're starting to increase. And so to be competitive, a wrap mortgage is a great option for you and for your buyer who might want to take advantage of the low interest rates that were previously available. So doing that wrap mortgage, you could, and there's always loan assumptions and stuff, but this is allowing you to make more money on your investment in the long term. So this is something that is an asset-backed investment. So this is something you can offer to your buyers as an option. Now, there are risks. I don't want to ever represent that there's not risks and things. So I want to address those risks right now. So the first one is a due on sale clause. Your underlying mortgage does technically have a due on sale clause. So if the banks want to, if they find out you've sold it and you have wrapped that mortgage, they could call that underlying loan due. And that is a risk that you do take. Now, a lot of times there are ways out of that, and I'll address that in a minute. But often what happens most of the time banks aren't in the real estate market, they're in the lending market. And so as long as they're getting paid, they're happy. But there are times that they do want to call it due because they want to reopen up that money for something else, for other lending or something along those lines. And usually when they find out about this is when insurance gets submitted to that underlying mortgage and it doesn't have the original owner's name on there, because it needs to have the original owner's name in addition to that lender's name and you as a lender or the wrap mortgager. So that's one of the big things is the new buyer accidentally leaves off the underlying mortgageor's name. So, or borrower, how about that? So then the second risk is that your person that you lend to could go through a situation where they stop paying. And that is a risk. You would end up having to take over those underlying payments and making those underlying payments while they're not paying. Now, there are ways to mitigate these risks, and that's the final thing I want to go to today. And to learn more about this, definitely give me a big thumbs up, make a comment below if you want to learn more about a wrap mortgage. But here's a couple of things on how to mitigate the risk, and if you want to go the route of a wrap mortgage. First, you need to make sure that you have a realtor that can do a wrap mortgage. There are certain brokerages that their errors and omissions insurance does not cover the realtor in a wrap mortgage situation. So certain brokerages do not allow their realtors to do wrap mortgages. So if you are represented by a realtor and you want to offer that as an option, then you either need to make sure they can do it, or to get some sort of, have that realtor get some sort of exception through their brokerage to go ahead and do it. So that's one thing you need to make sure of. The second is to make sure that when you work with title and an attorney, that title or attorney, actually their underwriting title insurance will cover a wrap mortgage, and that basically that mortgage that is going to stay in place. So you need to make sure that your title company will cover that. So you need a realtor that knows how to work these and has those title companies behind them that can help you with this option. Now, the third thing is that due on sale clause. A lot of times a lot of people just leave it and don't mess with it and let that due on sale clause be there. And if that does, it's a risk that they take. But another option is to put it in a land trust and then deed or sell that trust to someone else, because the trustees are not public knowledge and are not public. A bank cannot foreclose on a trust just because of someone were to deed it into a trust. So that is an option. Definitely talk to your attorney about that. You want a real estate attorney. Again, get a great realtor that knows a good real estate attorney that can advise you on this. But that is an option if you want to mitigate that risk, is to actually put it in a land trust. The next thing is to get an RMLO. That's a registered mortgage lending officer that can verify that the person that you're lending to is actually a viable person to lend to, if they have the assets to lend to, if they have the wherewithal to cover that mortgage. That's something that I would highly recommend. It's not required, but it mitigates your risk of that person not being able to pay. Now, the next one is making sure that as the person that is wrapping the house and becoming the bank to that buyer, you want a promissory note, you want a deed of trust, and you want to be listed as an additional insured on the insurance. Now, the promissory note makes sure that they're going to repay you. The deed of trust is if they stop paying, you can foreclose on them, and that does mitigate some of your risk in if they stop paying. You can foreclose or get a deed in lieu of foreclosure. And then the third one is additional insured. So if something were to happen to the house and it got burned down, you would still get your money in that insurance. You'd get paid first to pay back for that complete loss. So those are all three things that you would want in that situation. Now, there is, again, you want to make sure that you have an insurance company that is used to dealing with subject tos and mortgages. So again, a realtor that has dealt with these type of things is definitely going to be the person that you want to talk to, because some insurance companies will say, oh yeah, we've done it, but then they still end up messing it up, and then a deed or the due on sale clause gets triggered, and then the buyer ends up having to pay, and they may not have wanted to pay at that time. But some of the things that you can do and reasons why this is helpful for a seller is that a seller can actually look at, a lot of times buyers, especially ones that don't necessarily qualify for a traditional loan, or they would be given insane rates, may look into doing a doing a wrap mortgage, because they may own their own company and their CPA has been able to make their net income as low as possible so that they ended up not having to pay crazy taxes. But that net income looks bad when you're going to actually apply for a mortgage. So that's something that why certain people may look for a wrap mortgage. Now, another type of person that might look for a wrap mortgage is someone that doesn't necessarily have a W-2 job as well, that has a lot of cash on hand, but they wouldn't be able to qualify, or they don't have the traditional type of bank accounts and that sort of thing, but they can show that they're making really good money. That's why you want the RMLO there. And so those people also are willing to pay a premium, because that premium is basically the cost that they're not having to pay to a lender to generate or originate a mortgage. So definitely you want to look into those people that might pay a $15,000 premium just to be able to get a wrap mortgage. And it makes the value of your home worth more if you could offer a wrap mortgage that might be less than someone going to get a traditional loan. So these are all things as to why a wrap mortgage would be appealing to a buyer and could be appealing to a seller. And so definitely, if you're looking for more information, let me know. Again, give me a big thumbs up, throw a comment below, and I'm happy to talk more about wrap mortgages with you. And I hope you guys found this information helpful. I'll talk to you all later. Bye for now.